Welcome everyone to a new series, Unpacking Transfer Pricing, where we aim to demystify complex transfer pricing concepts for our listeners who are interested in transfer pricing. Today, we introduce our listeners with the first chapter of the OECD Transfer Pricing Guidelines issued in 2022, the Arm's Length Principle. The Arm's Length Principle is the bedrock of transfer pricing practice. Our goal today is to give you a high-level understanding of transfer pricing. This isn't professional advice, and for specific situations, one should always reach out to actual transfer pricing consultants. Think of this as your foundational knowledge builder. A link to a detailed audio-only description is available in the comment section below. So, let's begin. The arm's length principle is the cornerstone of international transfer pricing, ensuring fair market transactions between multinational enterprises and independent entities. It aligns with Organization for Economic Cooperation and Development guidelines, promoting equal tax treatment and reflecting economic realities. This principle helps prevent profit manipulation, though it poses administrative challenges for both taxpayers and tax administrations. The arm's length principle ensures fair market transactions by aligning tax treatment between multinational enterprise groups and independent enterprises. It reflects economic realities, focusing on conditions akin to those between independent enterprises. While it avoids tax manipulation assumptions, it poses administrative challenges for taxpayers and tax administrations, maintaining international consensus on transfer pricing. Independent enterprises rely on market forces to shape their commercial and financial relations, with competition directly influencing prices and conditions. In contrast, associated enterprises may not be as affected by these forces, often replicating market dynamics internally. Their relationships can influence bargaining outcomes, leading to conditions differing from those between independent enterprises. Article 9 of the OECD Model Tax Convention underpins transfer pricing, emphasizing conditions between associated enterprises that differ from independent ones. It allows for profit adjustments to reflect market conditions. This forms the basis for bilateral tax treaties and comparability analyses, treating multinational enterprise group members as separate entities, aligning with the arm's length principle. The arm's length principle treats multinational enterprise group members as separate entities, focusing on transactions and their comparability with uncontrolled or independent transactions. This approach assumes associated enterprises operate independently, influenced by market forces. Unlike traditional business treatment, it emphasizes distinct entities, independent transactions, and market conditions, ensuring alignment with the arm's length standard. The comparability analysis framework is essential for applying the arm's length principle. It compares controlled transactions between associated enterprises with uncontrolled transactions to identify necessary adjustments. Key considerations include functions, assets, and risks. The goal is to determine if adjustments are needed to reflect arm's length conditions and calculate the profits that would have accrued at arm's length. The arm's length principle ensures competitive parity by aligning tax treatment for multinational enterprise groups and independent enterprises, preventing tax distortions. It has gained international consensus, forming the basis for transfer pricing globally. By eliminating tax biases in economic decisions, it fosters international trade and investment, driving economic growth. Its effective application is evident in commodity transactions and financial lending. Applying the arm's length principle faces challenges like unique transactions that independent enterprises wouldn't undertake, and information limitations due to confidentiality or lack of comparables in vertically integrated industries. Additionally, the administrative burden is significant, requiring extensive documentation and judgment from both tax administrations and taxpayers, highlighting the complexity of transfer pricing. Global formulary apportionment proposes allocating profits using a predetermined formula, ignoring market conditions. This method risks double taxation and allows formula manipulation. It creates administrative complexity and compliance burdens, requiring extensive documentation. Despite these challenges, The arm's length principle remains preferred, as it aligns with actual market conditions and treats associated enterprises as separate entities, ensuring fair tax treatment. By and large, global formulary apportionment method was not widely adopted. Local market features significantly impact transfer pricing under the arm's length principle. Infrastructure, workforce availability, market proximity, and regulatory environment can create operational advantages or disadvantages. When local comparables are unavailable, distinguish between market features and intangibles, assess market advantages, and determine allocation of net benefits, ensuring alignment with independent enterprise practices. Multinational enterprise groups benefit from synergies like combined purchasing power and economies of scale. Incidental benefits from group affiliation need no separate compensation. However, deliberate actions, such as centralizing purchasing, require comparability adjustments. Benefits should be shared among members proportionally, rewarding the coordinating entity appropriately for their role in achieving these synergies. Consider a parent company P with a AAA credit rating, its subsidiary S with BBB credit rating. Due to group association, S can obtain loan at A-rated interest, one notch above its standalone rating of BBB. This benefit of borrowing at a lower interest rate without needing to compensate the parent. However, if subsidiary S obtains loan with AAA rating interest rate due to explicit guarantee by parent P, then there should be an arm's length guarantee fee to be paid by S to P. In another case, a central purchasing manager negotiates group discounts, reducing widget costs from $200 to $110. It would then warrant an arm's length compensation of, say, $116, which would include service fee. These examples are to highlight that if there is explicit benefit, combined with deliberate and concerted effort, such transaction should be compensated at an arm's length price. The arm's length principle is crucial for international transfer pricing, ensuring fair tax treatment by treating multinational enterprise group members as separate entities. It relies on comparability analysis to align controlled transactions with market conditions. Despite its robustness, challenges arise in integrated businesses and administrative burdens, yet it remains the foundation for reflecting economic realities in cross-border transactions. That's all for this episode of Unpacking Transfer Pricing. Remember to seek expert advice when taking business decisions. Do join us in this 10-episode series where we delve into fascinating area of transfer pricing. Until then, keep learning.